Every major economic era has a technology that captures the imagination of businesses, investors, and policymakers at the same time. In the late 1990s, it was the internet. In the 2010s, it was mobile and cloud computing. Today, it is artificial intelligence. AI is being discussed in boardrooms, earnings calls, and government briefings with an intensity rarely seen before. Some see it as a foundational shift that will reshape productivity for decades. Others warn that expectations are running far ahead of reality. To understand whether AI represents a true boom or the risk of a bubble, it is important to separate lasting structural change from short-term excitement. The case for an AI boom starts with real adoption. Unlike many past tech trends, AI is not confined to experimental labs or niche startups. It is already embedded in customer service systems, logistics planning, marketing analytics, fraud detection, and software development. Large companies are integrating AI into core workflows, not just testing it on the side. This level of integration suggests that AI is not a passing fad, but a technology with broad applicability across industries. Another reason the boom narrative has traction is productivity pressure. U.S. businesses are facing long-term labor constraints from demographics, skill shortages, and rising costs. AI offers a way to scale output without scaling headcount at the same rate. Even modest productivity improvements, when applied across large organizations, can have significant financial impact. This structural need for efficiency supports the argument that AI investment is responding to real economic forces, not just hype. There is also evidence of durable infrastructure spending. Companies are investing heavily in data centers, cloud capacity, networking equipment, and specialized chips to support AI workloads. These are capital-intensive, long-term investments that would not be made if firms believed AI demand would disappear quickly. The build-out of AI infrastructure resembles earlier phases of cloud expansion, suggesting a multi-year growth cycle rather than a short-lived surge. However, alongside these signs of a genuine boom, there are clear signals of bubble-like behavior. One of the most obvious is valuation. Some companies associated with AI have seen their market values rise far faster than their revenues or profits. In many cases, future AI potential is being priced in years ahead of proven business results. This does not mean those companies will fail, but it does mean expectations are extremely high and leave little room for disappointment. Another bubble warning sign is how broadly the AI label is being applied. Companies across sectors are rebranding existing products and services as AI-powered without clear differentiation. This kind of labeling inflation often appears when a technology becomes fashionable. When nearly every business claims to be an AI company, it becomes harder to distinguish genuine innovation from marketing-driven adoption. Execution risk is another factor fueling bubble concerns. Implementing AI at scale is far more complex than deploying traditional software. Data quality, system integration, regulatory compliance, and workforce training all present challenges. Many companies underestimate how long it takes to generate measurable returns from AI investments. If promised efficiency gains fail to materialize on expected timelines, confidence could weaken quickly. There is also growing recognition that AI does not eliminate costs as easily as early narratives suggested. While AI can automate certain tasks, it also introduces new expenses. These include computing costs, data management, cybersecurity risks, and the need for human oversight. In some cases, AI shifts costs rather than removing them. Businesses that expected immediate margin expansion may be forced to recalibrate expectations. The labor impact of AI further complicates the picture. Early fears of mass job displacement have not fully materialized, but neither has seamless productivity transformation. Many roles are being reshaped rather than eliminated, requiring retraining and organizational redesign. This gradual adjustment supports long-term adoption, but it also slows the pace at which AI delivers dramatic financial results. Comparisons to the dot-com era are common, but imperfect. During the internet bubble, many companies had little revenue and unclear paths to profitability. Today, many AI adopters are established firms with existing cash flows. Even if some AI investments underperform, the underlying businesses are unlikely to disappear. This suggests that while there may be pockets of excess, the overall system is more resilient than past bubbles. The distinction between the AI boom and a potential bubble becomes clearer when looking at where value is actually being created. Companies using AI to improve core operations, reduce errors, enhance customer experience, or support decision-making are more likely to see sustainable benefits. In contrast, firms relying solely on AI narratives to justify expansion without operational change face higher risk. The boom is real where AI solves specific, measurable problems. The bubble risk appears where AI is treated as an abstract promise. Investor behavior is also evolving. Early enthusiasm rewarded almost any AI-related announcement. More recently, markets have begun demanding evidence. Investors are asking how AI improves margins, speeds processes, or strengthens competitive position. This shift toward accountability suggests the market is moving from speculative excitement toward more disciplined evaluation. Over time, it is likely that both perspectives will prove partly correct. AI will continue to transform how businesses operate, making it one of the most important technologies of the decade. At the same time, some companies and projects will fall short of expectations, leading to corrections in valuations and strategy. This pattern is typical of major technological shifts. Understanding the AI boom versus the potential AI bubble requires nuance. AI is neither a magic solution nor an empty promise. It is a powerful tool whose impact depends on execution, integration, and realistic expectations. The businesses that treat AI as long-term infrastructure rather than a short-term narrative are more likely to benefit as the hype fades. In the end, the AI story is not about whether the technology matters, but about how it is used. The boom reflects genuine progress and investment. The bubble risk reflects human tendency to overestimate speed and underestimate complexity. As the market matures, the distinction between the two will become clearer, leaving behind a more grounded and durable phase of AI-driven business transformation.